do is get, and then I put this out to Facebook. So bear with me a moment while I jump on Facebook and put it out there as well. Okay, so we are live on Facebook now. And then the last thing I need to do is share my screen so that you can see what I'm trying to show you as presentation. Okay. All these technical things we got to figure out here. So just bear with me just a moment if you can. Can everybody see my screen?
Yeah.
All right, great. Okay, so next I'm going to go through the sponsors, if I can get that to kick up on my screen here so I know what I'm talking about. All right. So that was our networking, and I bet you these next few slides talk about what you should be doing in networking. And of course, it's way too late for me to have said any of this. So I always like to start the meeting off with a tribute to Gene Guarino, because Gene is the guy that got me involved. Gene is instrumental in the assisted living world here. He founded the RAL Academy, the RAL National Association, and Gene introduced thousands of people to the model of the residential style assisted living. His motto was do good and do well. Unfortunately, we lost him back in 21. But his legacy still lives on. His daughter's doing a good job of keeping both of those RAL functions going well. And they also have a national conference in September of every year down in Phoenix. We just went to that just a few months ago. And I would highly suggest that if you have an opportunity to go to Arizona in September of 2024. So we've got our website. It is the DAALR.com website. And this is a lot of information. Most of it's kind of geared toward Colorado because that's where we're based out of. But even so, we've got a lot of good information in there that you may want to take a peek at. Most important is probably this helpful links page if you are in Colorado. This is extremely important. These two are the very first couple links on that. So if you're running assisted living in Colorado, this is the rules and regulations that you need to know like the back of your hand. We've put all these links into the helpful links page so that they're easier to find, because trying to go through the state to find these things is really cumbersome. So all you have to do is go to our DAALR.com website and go to the helpful links, and we've got shortcuts to all that stuff for you guys. Also, we have our Facebook page, and we ask everybody to join that because it's a good community. So if you have something to give to the community, want to talk to them into, talk to somebody, ask them questions, whatever it is, this is a great place to go. So we just ask if you can join it and be a part of it and make it useful for you and other people. That would be a terrific thing. Next, we've got our meetup page, and we appreciate everybody that does sign up and log into this. It just gives us an idea of how many people are going to attend. So we appreciate those that have signed up in there. We also use it as a platform for communication. Next, I want to go through our sponsors. We've got quite a few sponsors that help our group. And so let's get started, and we'll kind of go through these. Hall Ryan Construction, 35 years of combined construction experience. The exceptional team at Hall Ryan Construction has transformed residential and commercial properties by bringing a high-touch, customer-centric approach to every engagement. On the insurance side, Hall Ryan's reconstruction and roofing expertise is a skill that many insurance companies actively seek out. Their reliance on Hall Ryan's experience is helping them write estimates, has made Hall Ryan a well-respected, trusted expert in the field. We've asked them to do some quotes for us, and they've been Johnny on the spot getting those numbers back to us. So if you're here in Colorado, give Hall Ryan Construction a try. Next is the Palm University. This is Brett Chapkavis. And Brett's actually presented for us a few times. He's put together a really nice program for high-end 16-bed model. This is like a level 4.5, level 5. Also on his website, it's a great collection of training videos, and they're geared toward experienced operators. So if you navigate to palm.university, I know that's a weird one because it's instead.com, palm.university, you can get more information about what Brett's doing over there. Okay, next we have the RAL National Association. So if you are in this business, you definitely want to be a part of the National Association. We are all stronger when we are a bigger group. So these folks are doing legislation, and there's group opportunities and all kinds of really good stuff for operators on the national level. If you are a member of Denver ALR, then you get a free associate level membership, newsletter, and the access to that group purchasing benefits. If you're just getting started in this, wanting to learn about it, then we recommend the RAL Academy. And the RAL Academy, I call this basic training for assisted living. So if you're wanting to learn about assisted living, they've got a great course. You can go do it in person. They've got a nice 3-day course. They've got an online course, and they do a full mentorship program. So, or if you're just getting started in this and want to learn more about it and you're serious about it, we have a link to it up here. RAL Academy goes right there. So go ahead and click on that and check them out. Next is assisted living marketing. If you have an assisted living and you want to, we highly recommend you need to have a website. And this is the guy, and Peter happens to be in our group tonight. So Peter, would you like to chat a little bit about your company?
Yeah, real quick, guys. We can start from graphic design, get your logo and your branding put together for you, and can create your business cards and brochures. But all that really is all tied together with your website. And if you want to go farther than that with more digital marketing, then we can help you with that as well. So happy to always have conversations about that and give folks ideas on easier ways to do things, faster ways to do things. But it doesn't have to be expensive to get those things done. So super affordable. Been working in the space for 14 years. Love what you guys do, and happy to help any way we can.
Thanks, Peter. And I'll also throw out there that Peter's been doing my websites for a number of years now. And Peter's, I've been dealing with webmasters, guys like Peter, for well over 20 years. He's been the most responsive guy that I've ever worked with. I really, really, really appreciate it. He does every website that we need done. And it's been a real pleasure working with Peter. So I highly recommend him. Okay, and next we're going to talk about senior care administrator coaching. If you are in Colorado, Janet Cornell, this is her company. She's got a lot of experience, years and years and years of experience dealing with assisted living. She now no longer operates these, but is instead a consultant. She can provide the 40-hour administrative training, and her course, I think, is the best course in Colorado for that administrative training, because she gets into the real nuts and bolts, not just the surface part of it. So I highly recommend, if you need your administrator license, then she's the gal to go to. If you need a consultant, she's the gal to go to. Staff training, employee file compliance, compliant documents, all that stuff, she's the gal. So take down her website, scac-janet.com. Next, ICOR. ICOR is the investment community of the Rockies. It's the only national recognized, Colorado's only nationally recognized and award-winning real estate investors association, serving Denver Metro, Colorado Springs, Fort Collins, and Northern Colorado. And any other real estate and rental property investors across the state. I've been a part of ICOR since I think 2014. They're a fantastic group. I've learned so much from them. There's so much value in some of the courses that they have. I don't think you can get a better deal for the buck than you can get from these folks. So look at icorockies.com. And again, this is Colorado, but anybody out of state could also benefit from what ICOR has. Next, we have Colorado's, and I shouldn't just say Colorado's because they actually work nationwide, but Pinkowski Law, and they help developers and operators of assisted living and group homes locate and establish their facilities so they can focus on the business of caring for people. They'll act as your advocate and work with your local council, if you're out of Colorado, to encourage compliance with the Fair Housing Act provisions. If you run an assisted living and you're wanting to increase your bed count, these are the folks you want to talk to. If you're fighting the HOA or fighting the city and you don't think it's right, well, the Fair Housing Act applies to seniors that need assistance with the daily activities of living. It's not that they're old, it's that they need help. So the Fair Housing Act is a federal law. It overrides any of the local and state laws, and these folks will help you convince the local government that the federal government has more pull, and what the federal government says about fair housing is more important than what they think their rules are. So PinkowskiLaw.com is the place to go for that. Next, I want to talk about one of my favorite groups, A Better Way Funding. And I work with and for A Better Way Funding. So we do lease options for group homes. And if you want to see what that whole program is about, you can take a look at the ralleaseoptions.com, and that will explain the program. But if you're looking to get in this business, and really, we probably are best fit for someone who's already in here and looking to grow, then this is where you want to be. Next, my absolute favorite, because this is my company, it's Grand Avenue Business Brokers at A Better Way Realty. And so I have over 30 years of business experience. I actually started my first company in 1987. So I don't know if that makes me really old. I've done well over 60 assisted living transactions, over 100 million in transactions. I am a certified business intermediary, and of course, my specialty is assisted living. And here's a slide I forgot to update, but let's see what the changes are. Let's see, available now, actually it's 58 beds we have in East Colorado. We still have the 16 in North Metro, and that is approved for the ABW funding. We still have this deal in South Metro for 3 8-bed businesses, and the leases, you would take over the leases, but it's $50,000 to $5,000 each to take these. We've got another 12-bed available northwest of Denver. Under contract that we are closing next week is 56 beds. We have another 32 beds we're working on, and 8 beds on the western slope. And the bed south of Denver, we closed that about 2 months ago, so that part is a little bit old. Next, we have the Colorado Assisted Living Association, and I happen to have Peter Brissett again, who's on the board from CALA, to tell us what they're doing right now.
Yeah, we got a couple training events coming up here. The first one's actually next week. It's Tuesday at 2:00. It's a 2-hour training. There are 3 bills that have been passed over the last couple of years that go into effect on January 1st. There's the dementia bill, the visitation bill, and Senate Bill 22-154, which increases the fines for not meeting regulations, as well as a number of other changes in the regulations. So we're doing a training next Tuesday to kind of update everybody on what's going on with that and what's happening. So if anybody here is in Colorado or otherwise and wants to get caught up on that training, shoot me your email and I'll make sure you get the notification so you can get signed up for that. And then additionally, part of the regulation change with Senate Bill 22-154 is that if you took the original 30-hour administrator course, you are required by the end of June next year to get additional 10 hours of training, which we will be conducting a 10-hour class in January for folks that need to get that 10 hours made up. So a couple of things we got going on. If that's something that you need to be part of, shoot me your email and I'll make sure you get the notices.
Fantastic, Peter. If you have an assisted living in Colorado, you should be part of this group. They are your advocates. And I think it's very important because, again, together we're stronger. And I think Cal is a great group and they're doing great things. And I'm happy that we've got a nice symbiotic relationship with Cala.
Yep, for sure.
Okay, I think I've chatted a lot, and now I'm going to talk a little bit about banking on yourself. So this is really a concept. It's really hard to understand, and it takes a lot to it takes a real mind shift to figure this stuff out. I've been looking at this for 2-3 years at least. I finally pulled the trigger this year and opened up my policy and my wife's policy. And I really thought that this is good information that we want to share. And I know we had Hannah scheduled for tonight, but we had some scheduling conflicts and it's all my fault. So I want to put that out there. It's completely my fault, but she was able to call in Mike Fry, who graciously at the last minute decided to jump in and help us. So from Odessa, Texas, let me introduce Mike Fry.
Hi, guys.
All right, Mike, I'm going to turn the controls over to you, and you can share your screen and let us know your presentation. Oh, I do want to say one more thing, folks, is if you can go into the chat and put in your information there. Just my last pitch at getting you to fill the stuff up. So go ahead, Mike.
Okay, hang on a second.
Bear with us 1 minute.
Oh, by the way, Mike's got his wife helping us because he says he's computer challenged, but she's not. So
I am computer challenged.
Okay. It's not. Oh,
we had it there. We could see it for a moment.
yeah. It's over here.
Well, I can hold that. Okay, now there's one over there. There it is. But where's the?
I apologize. Apparently I'm computer challenged too.
That's all right. We had it there for a minute. So you hit share screen and then pick the screen you want to share.
There it is.
There we go. Can you
Can
guys?
you see it?
Not yet.
Okay. Why is it doing that?
It's gotta be the black one.
There we go.
All
There
right.
should be.
There.
Good.
All righty. Are you able to see it, Vern?
Yeah, we can see
Okay.
the PowerPoint main one, and that's okay. That works fine.
There it is, right there. It's paused, that's why. Go to live. See if she can flip it, see if it. Oh, the other way. Did it change?
No, it hasn't. But if you just click on the icons on the left, you could change it that way, or you could hit the page down to get it to change.
They're seeing this.
Mm-hmm.
That's all right. They just have to see it.
It's just not letting me.
We'll change it this way.
Well,
So if you go to slideshow and begin presentation, I think is how I would typically do it.
that's what it's not letting,
Let's do it.
it's not letting us start the presentation.
Oh, okay.
So that's the challenge we're having.
We can see this screen, so if you want to go off of this screen, it'd be okay.
Let me stop the share and restart it. Maybe that's it.
Do you know how to do this?
Okay. You
Well, here, come here, walk in.
you jump in there.
It's gotta be presentation one.
So the,
It's underneath that,
I got you. Okay.
but it won't share.
It won't go to the presentation mode.
Right there, that's the one. Scroll back one, see if it goes backwards.
I would just go with what you have.
That one would work too.
Yeah,
Just go with what you got.
yeah, let's see if I can do it. Okay,
I think
can you guys see my picture?
Yes,
Okay. All right, I apologize for all that.
no worries.
Basically, what we do is we create our own banking system using a life insurance policy. We do it to get out of debt is the main reason. I'm going to tell you a little bit about me and my wife's story. We lived in Pennsylvania. I grew up on a dairy farm, and we was taught that you get a good job, want to buy a car, buy a house, you borrow money from the bank and you pay it back. Well, that's great. So me and my wife got married and we got into real estate, and we owned 11 properties, and we had money coming in, but money was going back out. We couldn't seem to hold on to anything. And we met Brent Kessler, and Brent told us about infinite banking. So we were 840,000 in debt at that time. We bought a $10,000 policy and we started using infinite banking. Within 4 years, we had 7 policies and we were debt free. We took that money then, paid back all our policies, and we started using it as investing. I now am invested in 14 deals that are private to me. I own real estate in Pennsylvania and Texas, and we actually are invested in multifamily syndication. We did all this by using our own money over and over again. We recaptured our debt. I'm going to give you a couple resources where these are good things to get into your financial life. Becoming Your Own Banker was written by R. Nelson Nash. That's the book that I read first to get into infinite banking. The other book is Mapping Out the Millionaire Mystery. Brent Kessler and Chris Noggle actually wrote the book. Brent is my mentor. He's the one that taught me how to do this. The problem in America isn't so much what people don't know, it's what people think they know that just isn't so. Most people do not understand how money works. Through this presentation tonight, I'm going to explain some things about money that you probably don't understand, or you think you do, and it's just not right. Your money flows through your hands and you pay your bills. But most of that money you never recapture. Say you buy a car, that money's going forever. When I buy a car, I get that money back, plus I have the car. We're going to show you that method. This is what we kind of call the guidelines to it. The mysteries of money, the machine, what we use, which is a whole life mutual policy, it's dividend paying. The mission, the marathon. This isn't a quick, rich scheme. This takes time and years. I've been doing this for 10 years. The millionaire and the movement. I got 3 calculators on the screen. Can you guys see them? Okay. Basically, I'm going to use buying a car scenario. And what I'm trying to teach you here is you can make money, borrowing money at a higher interest rate than you can actually make money borrowing money at a higher interest rate than you're earning at a given interest rate. So let me explain that. Say you have $25,000 in a checking account or savings account that you're actually making 4% interest on, okay? Now, I know most checking accounts and saving accounts don't make 4%, but say you can do that, okay? You come in to me and you say, hey, Mike, I want to pull my $25,000 out and go buy a car and pay cash for it. I'm going to tell you, no, you don't. I'm going to tell you, you want to take a $25,000 loan from me at 6% interest for 60 months, because most car deals are for 5 years. So for 60 months, your payment on that car deal would be $483.32. That's what you pay for 60 months. So let's look at the middle calculator. There's your $483.32 that you're paying for 60 months. And the total is $28,999. So you paid back the 25 and you're just short of $4,000. Okay. Now look what happened with leaving the 25,000 in at 4% for 60 months, same time frame. You actually made $30,525. That difference is $1,500. So I actually made money leaving my money in a bank at 4% when I borrowed it at 6% to buy the car. Does everybody know why that is? This money is increasing every day. So it's gaining. This is depreciating. So you're actually paying down the debt. That's how money works. The machine we use, it's a whole life, especially designed and engineered dividend paying whole life insurance policy from a mutual company. Mutual company means us as policyholders own the company. We have a say in what happens to it. Why do we use whole life? Because it's what the rich do to hold their money and keep their money. Here's the reason I use it. This slide was created by one of our members on the team. This side is the bank. This side's your policy. In both, your money's liquid. You can get it anytime you want. A bank's interest rate is a lot lower than the policies. The policies are 2 to 5.5%. It's non-interrupted and compounding. Your bank's money is taxable. In your policy, it's tax-free. It's unprotected in a bank. It's protected in your policy. Now, that's from lawsuits and judgments, and some states vary, but there's a way, if your state doesn't do that, there's a way we can assign it so it doesn't. If your bank is unstable, you don't know what's going to happen tomorrow. We've had some banks close lately. In your policy, it's stable for times of economic uncertainty. There's no death benefit with your money in the bank. And with it in the policy, there's a death benefit, which is general relational wealth. So that means like my kids are going to get my money tax-free. Why do we use whole life? Because it's what the rich do and what I just showed you. BOLI, bank-owned life insurance. Banks own more life insurance than they own real estate and property combined. They're one of the biggest buyers of whole life insurance policies. Can we make money earning 4% while paying 6%? I just showed you we can. What is the definition of money? It's a means of exchange. If you dumb it down, that's all it is. You need something, you use money to buy it. So we buy food with money, we buy cars with money, we buy houses with money. It's just a means of exchange. Back again, the purpose is to buy things we need. Who believes in using compound interest? Every one of you on here understand that compound interest makes money. What you're doing with your policy is you're putting your policy or your money in your policy, and it's setting in there earning compound interest. It's non-interrupted. Motion, it's a natural law. So if you put your money in the bank and it sits there, you're earning, or in your policy and it's earning interest, you can't use it, correct? We teach you how to use it in your policy. So when we take a loan from our policy, we actually just take a loan from the general fund of the insurance company. Our money that we put in that policy, it's still setting in there, earning non-interrupted compounding interest. Now, the insurance company charges you a 5% simple interest. So to clarify that, say you borrow $10,000 from your policy, it's actually coming from the general fund of the insurance company, but you only pay $500 at the end of the year to borrow that $10,000. Who has an IRA and a 401k? I had one. I actually closed it, paid the penalty, took the money, and I put it in a policy. Within 30 days, I started using that money that I would not have been able to touch till I was 59 and a half. I'm not even 59 and a half yet, but I am using the money that was in my 401k on a daily basis now. Is there any guarantees with an IRA or 401k? Brent says there's one. He says it can never go below 0. Who controls it? Somebody else. Most people don't even know what their IRA or 401k has in it, or if it's going up or down. What do you know about your retirement account? Same thing. Most people look at their statement that comes out quarterly and they can say, oh, I earned some money or I lost money. Or you might know if it's in low risk, intermediate risk, or high risk. That's pretty much what most people know about their IRA or 401k. Are your dollars worth more today or in the future? I got a simple question for that. How many candy bars could you buy 10 years ago compared to today? Your money was worth more back then than it is today. Your money's always worth more today than in the future. Do taxes go up or down? Since I've been alive, they've been going up. So Do you pay tax on seed or harvest? You want to pay tax on your seed. So when you put your pre-tax dollars in a policy, the growth of the policy is not taxable. Now I'm going to show you how a bank works. This to me is interesting. Say you have $100,000 you deposit in the bank. Now, I don't care what this number is. It can be $10,000. It can be $100. Remember, it's your money. That's what I want to show you. The bank's going to pay you 4% interest, which I know banks aren't doing that, but let's use that hypothetical. So what your bank does is they take that money out and they loan it to somebody to buy a home, and they charge them people 7%. Okay. The people that sold the home then deposit their money back in the bank. Happens again. You buy a car, they charge you 8%. The car salesman car dealer puts it back in the bank. So on this deal, I bought a new house. Now my wife wants to remodel the kitchen, so we're going to charge you 9% for a remodel. The contractor puts the money back in the bank. It's just a cycle. Credit card debt, you want to pay it off. Your bank charges you 12%. The credit card people put it back in the bank. So you made 4%. Well, when you put your money in that bank, it became a liability to the bank. So what they did is they loaned it out to other people to make it an asset for them. So between your money and the money they loaned out on the home, the bank made 3%. On the car deal, the bank made 4%. On the home remodel, they made 5% because they paid you 4%, but they're making 9%. And then on the credit card deal, they made 8%. So in total, you would think they made 20%, right? They paid you 4%, so 20 minus 4 is 16%. Is what the bank made, correct? Well, honestly, the bank made 500% on that money. Banks make between 400 and 1,300% on the money you leave in that bank. And if you don't believe me, on that right there's a website, DAALRfinancial.com. You can go look it up. You can look up the bank you use. They will show you that every bank makes over 400% on the money you leave in the bank. This part here, most people spend 20% on automobiles. They spend 30% on housing. They spend 40% on living, and they try and save 10%. So if you go talk to a financial advisor, he's going to try and show you how to save more money. What I'm going to do is try and show you how to take money from your auto and put on your savings. So we spend about 5% in interest on autos. We spend about 25% on housing, and we spend about 5% on living. So if I can take some of this 5% right here on autos and put it on your savings, did you not just double your savings? And I'm going to show you how to do that. This is how I buy cars. This is an illustration of an insurance policy. Now, this person's 30 years old, and they're depositing $10,000 in the policy for 10 years or for 7 years. But in the 4th year, now they put $40,000 in there. They pull out $25,000 and pay for a car. Okay. But look in 1st year, they could have actually pulled out $5,831. I would recommend you use your policy right away, but we're doing this to show you how to buy cars, okay? Premium deposit is what you pay for your policy. You can, this number you decide on. For the car deal, we're going to show 10,000. The age doesn't matter. It's just the factor of what you can borrow back. So the older you are, the less you can borrow back. But it doesn't matter because it all works the same way. The death benefit, we don't even talk about it too much, but there is a death benefit with this. Okay, this is a better picture of it. Okay, so this person put $10,000 in for 4 years. Here's their cash value. So it grows every year. So they pulled 25,000 out and paid for a car. Now, because you're borrowing money, you have to pay money back. So we treat our money the same way a bank would. So we actually are making a $500 payment a month for a year, which is $6,000. The calculator deal I showed you before, the payment was $483. We just made it $500. That's all we did. So we're paying back our policy $6,000 a year. So we put another 10,000 in, and this just keeps growing. So we're paying our car back here. That's our car loan being paid back to our policy. Okay. Should show me. Yeah. Okay. So there's the money we deposited. That's 25,000 for the car. So the total of what we paid back for that car is $30,000. We invested 70,000 for the policy. So that is 70, 80, 90, $100,000 minus the 25,000 is $75,000. But right here, I hope this circles. Yeah. We actually have $73,226 in our policy, and we own the car. So we recouped what, 90% of our money back? Yeah. So in year 9, we actually borrowed 25,000 from the 73. We're not paying any more back. We're still making a $6,000 a year payment, $500 a month for this $25,000 car here. We pay it for another 5 years. We didn't put any money into our policy. We just paid back our money. So we paid back 30,000 minus the 25 we paid for the car. So our net injection is $5,000. But look at what we have in there. $95,797. That's a net cash growth of $22,571. That's actually how we buy cars. Sorry, all right, there's 3 rules we have with doing this. Pay yourself first. Create the policy and put your money in there first. Pay yourself back with interest. Our money is as valuable as the money you borrow from a bank. So you have to pay a bank back interest. You want to pay yourself back interest. Me, myself, I call the bank and ask them what they're charging, and say they're charging 7%. I charge myself 10%. Recycle and recapture your money. That's all we're doing. It works for buying a car. What else does it work for? My personal experience, everything that comes in my household as money, as W-2, my investments, my real estate, all that money goes into my policy before I use it. Here's 2 more resources for you. Second Chance by Robert Kiyosaki. He talks about being your own banker, and Tony Robbins does too. I think it's chapter 5.2 or something in Tony's book, but they talk about the concept of it. So it's 2 more resources for you. This is one of my favorite parts of it. a lot of people I talk to throughout the week are in debt. We actually have what we call implementation team. When you take a policy with us, we actually get you over to them and they'll help you lay out how to pay off your debt. I'm going to show you this scenario. This is actually a true client of Brent's that we helped him design how to pay off his debt, and he did it with a $25,000 policy. Basically, here's your premium deposit, $25,000. He was able to borrow 14,366 out of it. Okay. So he has 12 debts across here. I'm sorry, guys. He has 12 debts across here. Discover, Chase, American Express, Barclay, Lowe's, Nordstrom, Wells Fargo, a private loan, a BMW, West Marine, a condo, and a house. If you guys take and add all these numbers up, it's $469,000 is what it is. So I want you to do something for me. Make it easy figuring. Take $450,000 and he's using $25,000 to pay this debt off. Take 25 and divide it into 450,000. It should go 18 times. But it would take him 18 years to pay this debt off using $25,000 if there's no interest. I'm going to show you how to pay it off a lot quicker. So basically what he did is he took the 25,000, he was able to borrow 14,366 back. He paid off the Discover card, he paid off the Chase, he paid off the American Express, the Barclay, and the Lowe's. Them cards are gone. That debt's, oh, excuse me, the Lowe's he just paid down from 9,000 to 7,000. So them 4 cards are gone. The money he was paying to them cards total up to $788. And we put that in a segregated account. So we just put it back into our policy for the 12 months of the year. So when that's done, there's a total of $9,456 that we pay back to our policy. So in year 2, you borrow another 25, or you pay another 25,000 in premium, which this year you can borrow a little bit more. You can borrow 14,871 plus the 956 that we've been putting back into the policy. So you now have $24,327. So then we pay off Lowe's, Nordstrom, Wells Fargo. We don't do anything with the private loan. And we pay down the BMW from 17,600 to 15,000. We take the money that we were paying to these loans because we already agreed to pay the loans. So we're just taking that money and putting back into our policy, which now is 1622. So during the course of this year, in month 18, the private loan actually pays off itself just by us paying it. So we take the 922 that we were paying to that and we add it back into our policy. So we're actually paying $2,544 back to our policy now. How do you climb a mountain? Well, you do it one step at a time. The man at the top did not get there, fall there. He climbed there. This is a process that takes time and due diligence to make it work. It's not, you're not going to get rich quick scheme. That's not what this is. It's a lifestyle. Is it possible to owe no man anything? I think you can never be debt free because you always have taxes and cost of living and buying groceries, things like that. Okay. In year 3, we put another 25,000 in. This year, we're able to borrow $22,438. Now, we've already put in, let me back up here one. We already put in 25,918 to our policy from our loans we were paying. So we take that and we add it to the 22,438, and we now have $48,356. We pay off the BMW and we pay West Marine down to $8,304. Okay. In the course of that year, the rest of West Marine gets paid off. So we put that money back into our policy. So we're now putting in every month $4,305. So at the end of that year, we put in a total of $41,980. Okay. In the fourth year, we put another 25,000 premium into our policy. This year, we can actually borrow more out than we put in. We can borrow out 25,966 plus the 41,980 gives you a total 67,900, and we pay down the condo from 81,000 to 12,000. Okay, that condo actually gets paid off in the 48th month. We put in a total of 25,000 the first year, 25,000 the second year, and 25,000 the third year. So we put in $75,000 in this policy. Our loans, we borrowed 14 out the first year, 14 the second year, and 22 the third year. So basically, we borrowed $50,000. How much do you think's actually in our policy? Come on. Won't let me do it. Oh, I just lost all the. Oh, there it is. We actually still have $75,000 in our policy because we're borrowing the money from the general fund of the insurance company. Our money is sitting in there compounding non-interrupted interest. Okay, let's go to year 3. Oh, there's my problem. That mouse is moving. Okay. So year 4, now year 5. Okay, so in year 5, we put another 25,000 in. We can borrow out $26,807 plus the 51,000 we've been paying back to the policy. So that's a total of 78,467. The house, we actually owe 181,000 on it. We pay it down to $102,000. So that year, now for the next 12 months, we're putting in $5,484 a month, which is a total of $65,008. Now, in the 6th year, you notice it went to $10,000 because the PUA dropped off because we don't need it to fund the policy anymore. So the policy went to $10,000 a year. Out of that $10,000, we can borrow $13,190 out. We open a second policy for $25,000, and we can borrow 14 out of that. So we had the 13, the 14, and what we was paying back is 65,808, which is a total of 93,359, and we pay the house off. Now, how long did I tell you it would take to pay that debt off? It was 18 years, right? We just paid that debt off in 61 months, 5 years and 1 month. We paid off $469,000 in debt. That scenario is what I did to pay off $840,000 in 4 years. let's go one step further. We agreed to the banks and the loan people or the third party creditors that we were going to pay that debt. So let's show you if now we own everything free and clear. I want to show you what happens if you keep using the policy the way it's intended. Our monthly payment well, I'm only going to use the condo and the house. The monthly payment on the condo was $1,179. We actually paid it for 61 months. Sam, I need to move this thing. I can't see my numbers. This needs to move. I gotta move it.
Over here?
Yeah, I don't care where you put it. I need that. Okay. So when we started with this condo, it was 122 months and we paid it for 61 months. So there's still 61 months left. Okay. So that's a total of $71,919. Okay. The monthly payment on the house was $14,021. That payment was for 219 months. So minus the 61 we paid on, we have 158 months left. Okay. So total together, that is $296,437. Okay. But remember, I told you we're earning 4% interest on this policy. So let's do it with that. 4% interest for 61 months on $1,179. The total was $79,715. 4% on the house, 158 months. Monthly payment was $1,421. The total is $291,993. So we basically made $371,708. We just put back into our bank or into our policy. Now that you know this, everyone should do it. If you don't do it, are you stealing from your children or your grandchildren? R. Nelson Nash put up or said, I hate this thing. I can't get it to go back. I'm not seeing that stuff, Sam. Okay. Warren Buffett said, if poor people would do what rich people do, they wouldn't be poor anymore. That's a good saying for me. I mean, I think about that a lot because there's a lot of truth to it. There's one of two things going to happen to us. We're either going to live, so would we be better off with this or without it, or we're going to die. Would our family be better off with it or without it? Here's Walt Disney. He wanted to start Disneyland, and after failing in the pursuit of traditional means of financing to build what would become Disneyland, Walt decided to provide his own financing. A large part of this came to be by collectively borrowing money from his cash value life insurance. Ray Kroc partnered with the McDonald brothers and opened his first McDonald's in 1955. In 1961, he bought out the brothers. Kroc did not take a salary for the first 8 years, and to help with cash flow, he borrowed money from his 2 cash value life insurance policies to help cover salaries and key employees. He also used some of the money for an advertising campaign for the mascot called Ronald McDonald. Pampered Chef. She used $3,000 from her life insurance policy to start Pampered Chef in suburban Chicago in 1980. By 2002, the company had grown into 700 million operations that was acquired by Warren Buffett for 1.5 billion. Today, the company boasts 12 million customers. So basically, this is what, man, I don't know how to move this thing. There it is. We don't even talk about the death benefit, but there is a death benefit to this. Policies are exempt from judgments, liens in most states. Internal values grow tax-free, so all the interest that you're earning in the policy is tax-free. Loans never have to be repaid. As long as you pay the interest back, that this 5% simple interest the insurance company's charging you, the death benefit covers the loan when you pass. The movement, take control of your financial life and join our members at the top of the mountain. Give me your name, email, or phone number, and we'll set up a consultation where we can talk one-on-one. There's my name. My wife is also an agent, and two of my family members work with the application team. So, guys, it's a life-changing event. I can't explain it any better, and I apologize for all the confusion tonight with the computer. But there you go. If you got questions, I'll gladly stay and answer them.
All right. I'm sure we got some questions. Jeff, are you going to ask some?
Yeah, it's probably Mike, thank you so much. This is probably a dumb one, but here goes. This sure seems legitimate. Is this something that the insurance companies, I mean, I'm assuming they're aware of folks are using them like a bank. Is there a chance that they might change their policies and try to slow some of this down in the future, or is this good money for them too?
Yeah, basically, they're taking the money and they're investing it in, a lot of it goes into real estate. Development of real estate and stuff. No, they don't want it to stop. The insurance company, we use 5 different life insurance companies, and every one of them knows what we're doing.
Okay.
Yeah, they actually help. Like sometimes we got some situations that are special and we can't design the illustration. So we go to the insurance company and tell them the scenario and they design it for us.
Oh, for heaven's sakes.
Yeah, this is something that should have been taught when we was kids. But
Yeah.
I got to give Brent Kessler a lot of credit because Brent actually has taken this to a new level.
Okay. And the insurance, I mean, I know this is probably kind of rare, but that an insurance company would ever go out of business. But do you all check I don't know what you call it, the ratings, the Standard & Poor ratings on the insurance companies? That's probably not the right term. I don't know what.
Here's what I'll tell you about it. Yes, it was a question I had back 10 years ago. If an insurance company is going to go out of business, there's another insurance company going to buy them.
Okay.
Most of the all the companies,
They're all A+ rated.
yeah, all the companies we use are A+ rated, but all of them have been in business for over 100 years.
Yeah, they're traditionally just been around a lot. Many of them have been around forever. So that'd be unusual for, I mean, they're just huge outfits. And anyways, that answers my questions. Thank you.
You're more than welcome.
So we have a company, I'm sorry, we have a question in the chat from Carlita, and that is, which companies do you recommend?
Well, we use one of 5. A lot of it depends. Like if you live in New York, we only have 2 companies we can use because New York has a lot of different rules and regulations up there. So you actually have to be licensed in insurance company in the state of New York to use. We actually have two we can use. What the way I actually do when I talk to somebody on the phone, I actually do my clients, the people that actually I talk to one-on-one, I do their illustrations. And the way I do it is I take their information, I get a feel for what they want to do. Because a lot of people want to pay off debt. So you want the most money you can get back out of the policy in the beginning of the policy because you're trying to get rid of your debt. So I take the numbers and I put them in the illustration in two different companies, and whichever company gives me the best scenario for that client, that's the company we go with.
That sounds
Yeah.
amazing. Thank you so much. I live in Denver, so I would definitely want to have some support with the companies that will be best suited for me living here in Denver.
It doesn't matter where you live, other than like New York. The insurance company will cover you wherever you are as long as you're in the United States. You can't live in Guam and get a policy. You have to be a US resident. But it doesn't matter where you live. The insurance company will cover you from wherever.
Awesome. Thank you for that clarification.
You're more welcome.
Mike, I've got a few questions. Can you go back to like year 4 or no, probably year 5 in your slides?
Yeah, well, let's see how I can do that.
Just push that back button a whole bunch of times. That'll get you there.
Andy, show me how to get, because the problem is their pictures on where my buttons are.
Yeah, it's okay.
I need that
I got it.
on another screen. I have to get my technical person here. Guys, I am not the computer genius, let me tell you that.
That's okay. The slides look great on this side.
Well, that's the first one I've ever do. This is the first time I've ever been on Zoom. I don't know nothing about it.
Where you going back to?
Year 4.
That's great.
Might be for you, but I'm having trouble with it. Hey, I'm real though. It's me.
You know, Mike, if you do about 50 of these, you'll have it figured out.
Okay, what's your card?
Well, good luck with me doing 50. No, actually, it was kind of interesting for me because it's something I've never done. So you said year
Okay.
4. There you go.
Yeah, that's good. Okay, so we've got 51,000 in that. And if we look at year 3, we went from 3,000 up to 4,300 in our payments.
Mm-hmm. Because
So
you paid off West Marine.
yeah, totally get it. We're now paying more than really. We took out a loan and we're supposed to be paying, let's say 10% on your example on that loan. And I don't know what that payment would be on a 25, but for easy numbers, let's just say that payment's, I don't know, $1,000 at a 10% rate. I don't know. But now you're putting in $2,000 extra, and then you're going to put in another $1,300, so you're at 4,300. So that extra money that you're putting in, the first question that I would have is, where does that go? Is it just sitting in there? Is it part of your policy? Are you getting paid the 4% interest on that remaining 41,000? So at the end of the day, when you've got everything paid off and you're sitting in there with, I don't remember what it was, 51,000 of cash in that miscellaneous account, are you earning 4% on that?
Well, right now, every insurance company's interest rate has dropped since we changed presidents. The most any insurance company is paying right now is 3.75.
Okay, ignore the number. Are you earning interest on that money? I know you're earning interest on the 25,000 you put in, and you got 75,000 in there. So you're going to get the 3.7 on that. Are you getting the 3.7 on the 51,660?
Yes, because you're actually paying back the loan. See, when we put that money back in the policy, they put it in a segregated account. They don't actually put it all back into the policy because the policy won't hold it. So that's why you end up buying more policies, because you can't overfund the policy because it becomes what they call a MEC, a modified endowment contract, which means the government can then step in and tax you on it. So
And that's my next
basically,
question. Are you gonna
Okay.
be taxed on that extra money that you put in there? If it's gonna go in there, and now you got 75 plus the 50,000, so you got 125,000 in earning interest. Are you being taxed on that 50,000 over, let's say, the interest amount, which is over what you borrowed? Are you being taxed on that?
no, because the actual interest, I think you're missing something there, because what you're doing is taking the money you was actually paying for, say, the house, okay? You were paying that money to a third party debtor. You're just now paying it back to yourself. So the interest is already there. You know, if you took the payment let's see what the condo was. Okay, the condo, you're paying 6.2% interest. You're still making the same dollar amount payment, which is $1,179, but that 6.2% interest is in that payment. You're just paying that back to yourself. So the interest rate you're paying back on that is 6.2% interest.
Is that
But
tax?
the thing is, the money won't fit in that policy. So Brent calls that miscellaneous account because he don't have no place to actually put that money. You're just holding that money till the next year. You can't overfund the policy. What'd we say that was? $371,000.
Mhm.
That policy in 6 years is not a $371,000 policy. So basically, you end up opening more policies if you want to truly put all your money back in a policy. I have 12 policies. Okay. I started out with a $10,000 one now. I have $50,000 policies because I don't have enough room in my 10,000 to put policy. The first year that we actually did this, I ended up buying four $10,000 policies. By the fourth year, I had 7 policies and I owned some property free and clear. So I sold the property and took the cash, the profit off them houses and opened other policies, because the more money I had to use, the quicker I paid off debt. I did it a little different than they explain here. I actually, instead of putting you called it 51,000 in year 4, that $4,000 that you're paying back, we say, to the policy, I took that $4,000 and I paid it on the principal of my next debt. So what I did by doing that, I was paying down what they could charge me on interest on that loan. That's how I paid it off even quicker. I broke this down to monthly because we were strapped. I mean, we couldn't go out for supper. That's how bad we were. And when we started doing this and I understood what was happening, I broke it down even farther than we explained. So when I paid off a credit card, or I own tractors, I paid off a tractor, the money I was paying to the tractor, I took that and I put it on the principal of my next debt and paid that debt down, or that principal down, so they couldn't charge me interest on that $4,000 I was putting on the principal. So I ate at my bills even faster. Does that answer your question?
Mm, it's still a little gray for me, but I'm sure once I get in with your team and start doing this on my own, then I'll
Well,
hopefully.
yeah, it's actually easier, Vern, when we use your numbers because it makes sense to you. But the thing I would say to you is get with somebody, myself, my wife, or any one of the other members, and actually let them break it down for you for your debt, because it makes more sense. but I'm the type of person, if I can get rid of debt quicker, I'm going to do it. So, man, me and my wife, we pinched every penny because we seen what it was doing, and we just kept working at it. You know, today, all my money that comes into this household goes through a policy before we use it. My life's really simple. I own real estate, so I have monthly payments coming in. All my houses I own. My houses are titled to me. So what the tenant pays me comes into my household as a check. I put it in my checking account at my conventional bank. All my investments with other people, that check comes in and goes in that checking account at my bank. On the 30th of the month, I have 4 insurance companies. On the 30th of the month, each one of them insurance companies has a number that I gave them to pull out and put back on my policy. So let's use easy numbers. Say I got four policies, so I put $1,000 a month back on each one of my policies. Okay. I pay all my bills with one credit card. It doesn't matter if it's a light bill, the food bill, whatever the bill is, the garbage bill. So that credit card by the end of the month is between $45,000 and $6,000, say. So then I call the insurance company and I say, hey, I need you to deposit $6,000 in my checking account at my conventional bank. They do. I write a check to the credit card. Everything's done. Very simple. My life is more simple now than it was back 10 years ago when I got into this. We was moving money from one place to pay the other and hope this bill didn't come due before we had to make this payment. I don't live that way no more, nor will I ever. You know, me and Sandy started this. My kids are in it. My grandkids are 6 and 8. They both have policies right now that I'm paying for and I control, but I am teaching them how to use infinite banking. My grandkids will never use a conventional bank other than to move the money. I don't believe in conventional banks. I'm not going to let them make 300, 400% when I can make it. And that's the way I look at it. So my grandkids, I tell them they can buy their first bicycle and I'll show them how to pay for it. And that's what we're going to do. You know, that's just the way I'm teaching my family, because when I pass and my wife passes, my kids get the money. So I want their kids to understand how to use it too. But if I have my way, my grandkids will never use a conventional bank.
And when you pass, what happens to that 51,000 in the miscellaneous account? Does that go away, or that go?
No, that would be in a policy. You know, in this scenario, Brent's using it to show you how to pay off debt. But I can tell you right now, by year 2, I'd have had another $25,000 policy because I'd wanted to pay that debt off faster. He did it in 61 months. I'd have moved that money and bought another policy, because you could actually took, well, what year is that? Hang on a second. Let me go back one. Why don't that want to work?
Operator error.
Well, that could be, but it's not letting me do it. Well, actually, you could actually bought a policy with that miscellaneous money. When he got enough money that he was paying back the miscellaneous account, he could have, when he got 25,000, he could have opened another policy and started the process all over again in the middle of the month if he wanted. You understand that? He's just holding that money to pay on his next debt. Brent's showing it where you do it yearly. You're just putting that money back into your policy or segregated account, whatever you want to call it. But me, I used that money on the next debt because I was eating at the interest. Bothers me. I don't like owing people interest. So I wanted to get rid of the interest. Well, by paying down the principal, they couldn't charge me on what I paid off on principal. Most people don't understand that.
But you don't pay taxes on it because you've already paid the tax.
Yeah, the taxes were prepaid. It's your money. You know, when you make a payment to pay off your mortgage, you've already paid taxes from your W-2 on that money. So it's not taxable.
Brent, it looks like you're poised to say something.
Hey guys, how are you? Great job, Mike Fry.
Hi, Brent. How are you?
Good, man. Hey, yeah, I just wanted to jump in because I know, Vern, you keep going back to the tax question. So all the taxes are paid because anytime you put money into the policy, you're paying that with after-tax dollars. So the thing you've done is you've already paid tax on that money, which is a great thing because that's what we want to do is we want to pay tax on our money one time only. We want to get it into a tax-free environment and we want it growing tax-free. Anytime you take a policy loan, that loan is never taxable. You've never paid tax on a policy loan. So the growth inside of the policy is growing tax-free. It's all growing tax-free inside of the policy. So the reason that we put money back into that account, which we call it, is called like the miscellaneous account, is because instead of sending the money all the way back to the policy, there's still debts and expenses to pay in this example. So there's no sense in sending the money back to the policy because you still have use of that money. The only time I pay back policy loans, and I have 28 of these policies now, I'm about to put my 28th policy in force this week, and I buy at least one policy between every 1 year and 2 years. The only time I ever put money back into the policy as far as paying back a policy loan is if I have no use for the money, but I always have a use. And if I don't have a use, I'm going to find a use for that money. And just like you heard Mike say, the thing that he does is he takes his money and he'll do like hard money lending. He'll put it into houses or real estate. So the thing we do is we take that money in the policy and we take it out and invest it. Like you guys, okay, that are here in the RL group, you guys are doing in all of these like all these residential, just like assisted living units. I mean, call like Isabel, which is the late Gene's daughter, and ask Isabel, that's kind of in charge and runs RAL now, right? Ask her how she uses her policies, right? She uses her policies to fund more deals, right? And that's what the majority of the people from RAL go to. And I know, Vern, you and I met, I don't even know how many years ago it was when I was speaking at an RAL convention, and I speak there every other year. I'll be back in 2024. I was there in 2022, right? So again, that's what you're doing. You're actually able to use the money. You're actually using the money while you're living instead of like waiting until there's a death benefit and you pass it on to the next generation. You're essentially using a portion of the death benefit while you're alive. And all that money that is inside of the policy, it's all compounding and growing inside of a tax-free environment. So your money is growing in that tax-free environment, uninterrupted compound interest, and you're using it at the same time. There is no vehicle on this planet that has these features and benefits that allows it to work this way. And if there is one, let us know what it is, because I've been personally trying to find one since 2006. So almost 18 years now, and nobody's ever been able to show me another, like as far as another vehicle. Now, the one thing that I'll say is for your listeners that are still left on the call, I would go to our website, www.themoneymultiplier.com, and go and watch the full 90+ minute recorded presentation again. All right, it's all on there. I think you go to resources and then you click, I think it says like watch Brent now. Watch that whole entire presentation. And also just like send Mike an email at his email, which is mike@themoneymultiplier.com. And Mike will send you the ebook that Chris and I wrote, Mapping Out the Millionaire Mystery. And he'll send you the link to watch the full recorded presentation that has all the spreadsheets that Mike went over that you can download again. So just go over it again and watch it. And so the more you get around it, right? The thing I always say, the more you get around the campfire and drink the Kool-Aid, it makes more and more sense. So, and then probably there's somebody on the call tonight there's somebody that should be on the call that's not on the call that probably needs, to go and watch the information. And again, guys, go out and Google our stuff, Google my name, the Money Multiplier. A lot of the stuff, as Vern, we do associated with groups like this one, real estate groups, a lot of RIAs. If there's any of you that follow Pace Morby out there, I speak on all the Pace Morby platforms on this. Pace is my client, and again, a lot of you in the real estate world know Pace, and I would definitely recommend, if you don't know Pace and if you're not following Pace Morby, you should follow Pace and watch what he's doing in the real estate world. And obviously RAL with like Isabel and her group and her people. I mean, get around that stuff. Those guys, they do very, very well. Isabel's community, Pace Morby's community, they do very, very well in the real estate world. And that's what I do with my money and my policy. I buy properties, I buy short-term rentals, long-term rentals, Airbnbs, VRBOs, and then I do a lot of lending. I lend money as real estate as collateral. So that money is working for me, because you never, ever lose money in a whole life policy in a mutual company that pays dividends. It's never, ever happened. Go look it up. You'll never find it. Because inside of the policy, you have guaranteed growth. It's not me telling you. It's not Mike telling you. Inside of that policy, you have a guaranteed, uninterrupted, compounded growth. And before you ever start or buy your policy, accept it, or pay for it, you will see all of that information. You will actually see what your policy is going to look like before you ever put it in force. So anyway, I just wanted to chime in on that. And, I purposely wanted Mike to do this. I know it was a very last minute deal for him tonight. I mean, extremely last minute, like the last hour. And, so Hannah called me and asked me, she said, "Hey, Dad, can you do this?" And I probably could have, but I purposely said no, because I wanted someone else to do it. And I really wanted Mike to do this. And he did a great job. And I would follow up with Mike on a strategy call so he can go over your individual plan, how it would work in your financial situation. And obviously, if Mike, he has questions, and again, right. So we all have mentors and we all learn. I mean, I'm learning every single day. I mean, God gave me 2 ears and 1 mouth, so I should be listening twice as much as I talk. I still have a hard time with that, but questions that Mike doesn't know, which he knows way more than he'll tell you that he knows. And Sandra, his wife, they've used this, they've implemented this in their life for years. His daughter, Casey, his son, Dustin. I mean, the whole Fry family. That's why their email is like, or they have one email called Banking with the Fries, so they're very, very good at this. They're very good. And I'm telling you, give Mike the opportunity to go through this with you in a detailed form. So this was his first of many, many presentations that he's going to be doing. And, the first one had to come at some time, and it's always best when it comes when you don't expect it and you actually have no time to plan for it. And even though the worst thing about the presentation tonight was the computer stuff, Mike was way better on the computer stuff than I ever am. So he's a step up above than me, because I totally suck. If you think Mike's computer skills suck, that's okay. Mine totally suck. But it's not about the computer skills that builds and keeps and creates our wealth. It's the team and the family behind us. And as you see, Mike had his children and his wife there with him to help us. So no, great job, man. I'm very proud of you, Mike Fry.
Well, thank you very much.
Yeah, good job. Let's give whoever's left, give Mike a round of applause. Do we have any more questions?
Hey, you go ahead, Carlita. Go ahead. I'm sorry.
I'm so sorry. I put the question in the chat about Primerica. Like I heard some information about them. Some good, some horrible. So I just wanted to get you all's opinion on like investing in a policy from Primerica.
Well, here's going to be the answer. And I'm very familiar with Primerica. You do not want to use Primerica, because here's what they're going to have. They're going to have what they call an index universal life policy, or an IUL. You never, ever, ever want to use an IUL for this concept. And we can give you lots of resources that show you why not. But the main reason is because an IUL has no guarantees. You can actually lose everything that you put in an IUL. And I will show you that on any illustration. So go to the person that gives you an IUL illustration, have them to email you the illustration, email it to me or Mike. We will go over it in great detail, and we will show you how you can lose every single dollar, because the cost of insurance and the fees that are associated with an IUL cannot keep up with the policy. So no, you do not want to use Primerica for it. You want to use a specifically designed, specially engineered whole life policy in a mutual company that pays dividends, that is designed and engineered for high immediate cash value. And when we say immediate, we mean in the first 30 days. So all the companies that we use are mutual companies. And what we do is we design your policy exactly like we design the policies for ourselves and our family. There's no secret sauce that we put on our policy that we don't put on yours. So when Mike has that strategy call with you, as he said earlier, he will show you what the illustration looks like, and as far as what your policy will look like, or what we project it to look like. But remember, even before you ever put your policy in force, you have to see your approved illustration, what the insurance company approves for you. And on that illustration, it will show you the guaranteed values of that cash value growth, the death benefit growth, and it constantly, Carlitha, gets better with age. Today's better than yesterday. Tomorrow's better than today. That's not us telling you that. That is actually in the policy contract itself.
Hey,
Wow. Thank you so much for that.
hey, Mike or Brent, forgive me, this may be another dumb one here, but these are life insurance policies. Is that correct?
Absolutely.
Okay, so does someone have to pass a health screening test of some kind to get these?
Yes, you do. So the thing is, in order to get a policy, the thing is you have to get approved for that policy. So anybody on this call that wants to start a policy today, it's not going to happen, because you got to get approved. The insurance company wants to make sure you look as good on the inside as you do on the outside. So they're going to ask some health related questions. You're going to pee in a cup. They're going to take a little blood. All that information goes to the underwriters of the insurance company. They will process it, hopefully approve it. Once that policy is approved, it will be delivered to you. Now, let's say if you're not insurable, right? Because right now, I am not insurable. I have lots of policies, but today I am not insurable. I have some health challenges going on. Hopefully one day I'll be insurable again, but that's okay. If I'm not, I can still own policies on other people. I can own policies on a spouse, a child, a grandchild, a niece, a nephew, somebody I have a vested interest in my business. So I can still perform everything that we talked about, that Mike talked about tonight. It just might mean I may not have a policy on my body, but as Mike told you about his grandchildren, he actually owns policies. He owns his grandchildren's policies, and he may even still own a couple of his kids' policies as well, because whoever pays for the policy controls it. He who has the gold makes the rules, right? So he controls and has every aspect of use of that policy. So he controls everything, even though it's on another body.
Thank you. And-
Banking.
And oh, I'm sorry. Was there? Okay. And does the insurance company or the government require that this is invested in by an individual, or could it be a company that invests in one of these?
Okay, great question. And I think you kind of asked this question a little bit earlier, and maybe or kind of sort of, but okay,
Yeah,
as far as in the policy itself, the thing you do is you have an owner, you have a beneficiary, and an insured individual. The owner and the beneficiary can change at any time, and it can change multiple times. The only thing that can never change is the insured individual on that policy. So the thing normally that we recommend is you either own the policy as an individual, or maybe a trust that you have owns the policy, okay? Now, you really don't want a corporation, a business, an LLC to own the policy. And the reason being is that these policies are appreciating assets. They go up in value. Today's better than yesterday. Tomorrow's better than today. So, and the thing you never want is you never want like an S Corp, an LLC, a company to own any appreciating assets. Because if that company gets sued and there's a judgment against that company, now that asset could be a part of that judgment. So instead, what you want to do is you want to own it individually, maybe have a trust own it and loan money to the corporation or the company. Like anyway, okay, Vern, I think you know my story. I mean, I'm like an ex-chiropractor. I mean, I'm still a chiropractor, but I don't practice chiropractic anymore, but I own chiropractic clinics. So in my policies, okay, I would loan money to my chiropractic clinics, and the clinics would pay me back with interest. They didn't own it, but I loaned money. The same thing in my real estate business or my investing world, Airbnbs, VRBOs, right? I loan money to those entities, and those entities pay me back with interest. But the government has nothing to do with these policies. This is not decided by the government and what you can do or what you can't do. The only thing the government does when it comes time to the policies we're talking about is there's certain MEC limits, MEC, modified endowment contract limits, that you're only allowed to do in the policy. And again, so that doesn't even become an issue, because every policy that we design is a non-MEC policy. And in order to create your policy as being a MEC, you would have to overflow that policy with additional cash. It would be like trying to get 12 ounces of water into this 10-ounce bottle. It won't hold it. It'll overfill. So guess what I do? If I want to put more water in here, I go get a second bottle and I put additional water into the second bottle. So we get a second policy whenever we want to put more money. And that's why our clients, the majority of our clients, have more than one policy. Because once you start your first one and you see how this works and how effective our team works with you, you will be blowing up the phone to do more.
Thank you. Thank you, guys.
You're welcome. All right, I'm going to turn it back over to Mike. I'm going to sign off here. But yeah, guys, I appreciate you having Mike on. And again, our whole organization is here to serve you. So please call, text Mike. Hey, Mike, can you throw up your contact info again? Or it's pretty easy. It's Mike@themoneymultiplier.com. Mike at themoneymultiplier.com. So just email Mike, ask him for a copy of the recorded presentation, our ebook, and whatnot, and he'll get all of that information to you. So again, guys, thanks for having us on tonight. And of course, Mike, great job, man. The first of many.
Thanks, Brent.
Yes.
Thanks a lot,
We-
Brent. Thank you, Mike.
Thank
Thanks,
you.
Mike and Brent. Thank you, both you guys. Sure appreciate you taking the time with us
Thank you
tonight.
so much. This was awesome. Thank you.
You're more welcome.
All right, well, we're gonna wrap it up. We're running a little past what we normally are, but that's okay. It was great stuff tonight. And again, Mike, for the last minute fire drill I put you guys through, I really appreciate you showing up and doing this for us. And
I was
good-
glad I could.
Yeah, me too. So, okay, well, if I'm going to sign off, if anybody wants to hang out and just network, you can do that. But we're at the end of our meeting tonight. This will be recorded and put onto our website, the DAALR.com website, dollar spelled DAALR.com. And thanks again. And we'll see
Have a
you
good
guys.
night.
There will not be a meeting in December because of the holidays, so our next meeting will be in January.
Thank you, Vern.
You bet. Thanks, everyone.
Good night.
Good night. Thanks again, Mike.
Yep.
Pleasure to meet you too.
Okay. Thank you.
You bet.